Assalamu alaikum wa rahmatullahi wa barakatuhu. Students, we will start with second textbook of accountancy, that is company accounts and analysis of financial statements. Okay. So the first chapter there is accounting for share capital. Okay. So a company form of organization is the third stage in the evolution of forms of organization. Okay, so its capital is contributed by a large number of persons called shareholders, who are the real owners of the company. Okay, so who is contributing the capital here? It is contributed by large number of person who are called as large number of persons who are called as shareholders, and they are the real owners of the company. Okay, but it is not possible for all of them to participate in the management of the company and to take the decisions. Okay, so therefore they elect a board of directors as their representative, okay, to manage the affairs of the company. So, in fact, all the affairs of the companies are governed by the provision of Company Act 2013. Okay, so a company means a company incorporated or registered under the Company Act. Okay, 2013 or under any other earlier Company Act. Okay. So what is company? A company means a company incorporated or registered under the Company Act 2013 or under any other earlier Companies Act. Okay. So according to Chief Justice Marshall, a company is a person, artificial, invisible, intangible and existing only in the eye of law. Okay. So a company is a person, artificial, invisible, intangible and existing only in the eyes of law. So being a mere creation of law, it possesses only those properties which the charter of its creation confesses upon it. Okay, earlier expressed or has incidental or its very existence. Okay, so now we will see what are the features of the company. Okay, so a company may be viewed as an associate of person who contribute money or money worth to a common inventory and use it for a common purpose. Okay, so it is an artificial person having corporate legal entity distinct from its members. Okay, it is a artificial person having corporate legal entity distinct from its member. Okay, that is shareholders, has a common seal, is used for its signature. Okay, and thus it has certain special features. Okay, so we will see what are the features of the company. So first is body corporate. Okay, so body corporate is the first feature of a company. A company is formed according to the provision of law enforced from time to time. Okay, so how is the company formed? It is formed according to the provision of law enforced from time to time. So in India, the companies are formed and it is registered under companies law except in the case of banking and insurance company, for which a separate law is provided for. Okay, so in India, the companies are formed and registered under companies law. Okay, but for banking and insurance company, there is a separate law which is provided. Okay, and second is separate legal entity. So a company has a separate legal entity which is distinct and separate from its member. That means the company and its members are not same. Okay, it is separate. Okay, so it can hold and deal with any type of property. Okay, the company can hold any property and it also can deal with any type of property, and it also can enter into contract and even open a bank account in its own name. Okay, so company can open a bank account in its own name and also it can enter into any contract in its own name. Okay, so this is the second feature of the company. Third is limited liability. Okay, so the liability of the members of the company is limited to the extent of unpaid amount of the shares held by them. Okay, So the liability of the members of the company is limited to the extent of unpaid amount of the shares which is held by them. So in case of the if it is a company's limited by guaranteed, the liability of the member is limited to the extent of guaranteed given by them. Okay, in the event of company being wound up. Okay, so their liability is limited to the extent of the amount that is guaranteed by the shareholders. Okay, next is perpetual succession. Or no, before that you have limited liability is done. Okay, fourth is perpetual succession. So as I've told you, a company is a artificial person which is created by law. It continues to exist irrespective of the change in its membership. Okay, so the members may change, the members may come and go, but it will exist, the company will exist irrespective of the change in the membership. Okay, so a company can be terminated only through law. Okay, so the death or the death of the partner or the death of the members will not or the insolvency of its member of the company will not affect the existence of the company. Okay, so the members may come and go, but the company will continue. Okay, next is common seal. Okay, so the company is is a artificial person. Okay, so it cannot sign. Correct, it cannot sign itself. Okay, so it cannot sign itself by itself. Therefore, every company is required to have a own seal. Okay, which acts as a official signature of the company. Okay, so the company, as it is the artificial person, it cannot sign. So every company has to own seal which acts as the official signature of the company. Okay, so any document which does not carry the common seal of the company is not bind on the company. Okay, it is not binding on the company. Next is transferability. Okay, that is transferability of shares. Okay, so the share of a public limited company are freely transferable. It can be transferred to one person to another very easily and very freely. So the permission of the company or the consent of any members of the company is not required for the transferring of the shares of public limited company. Okay, but the articles of the company can prescribe the manner in which the transfer of the shares will be made. Okay, that means the shares can be easily be transferred. It can freely be transferred. Okay, without any permission of its member. Okay, or the permission of the company is not required. But the articles of the company may prescribe the manner in which the transfer of share has to be made. Okay. And the last feature is may sue or be sued. Okay, so as I've told you, a company is a artificial person and it is a legal person. Okay, so it can enter into contract and it can also enforce the contractual rights against other. Okay, so it can enforce the contractual rights against other. So it can sue and be sued in its name if there is a breach of contract by the company. Okay, so these are the features of the company. Okay, next we will move on to the kinds of company. Now, companies can be classified either on the basis of liability of its members or on the basis of number of members. Okay, so what did I say? Company can be classified either on the basis of liability of its member or on the basis of number of members. Okay, so on the basis of liability, it can be classified into three categories. Okay, first is company limited by shares, second is company limited by guarantee, and third is unlimited companies. Okay, so this three categories comes under classification on the basis of liability of its member. Okay, so first is companies limited by shares. Now what is company limited by shares? So here in this case, the liability of its member is limited to the extent of the nominal value of shares held by them. Okay, that means here the liability of its member is extend to the face value of the share held by them, or nominal value of the share held by them. So if the member has paid the full amount of share, then there is no liability on their part, okay, whatsoever may be the debt of the company. Okay, so whatever may be the debt of the company, the member is not liable if they have paid the face value of the share of the company. Okay, if they have paid the full amount, or if they have paid the face value amount of the share. Okay, so such person who has already paid the full amount of share don't have to pay a single paisa from his private property. Okay, so however, if it is or if there is any liability involved, it can be enforced during the existence of the company as well as during the winding up. Okay, and second is companies limited by guarantees. Okay, now this is the second category. Okay, so here in this case, the liability of the members is limited to the amount they undertake to contribute in the event of company being wound up. Okay, so if the company is limited by guaranteed, in this case, the liability of its member is limited to the amount they have undertaken to contribute. They have told that they are going to give at the time of winding up. Okay, winding up of the company. So thus, the liability of the members will arise only in the event of its winding up. Okay, before that the members don't have to pay anything, but at the time of winding up, if there is any liability, then if there is anything the company has to pay, so this time the liability of the members will arise. Okay, not before that. Next is unlimited companies. Okay, so when there is no limit on the liability of its member, the company is called an unlimited company. Okay, so if there is no limit on the liability, okay, so when the company's property is not sufficient to pay its debt, okay, so when the company's property is not sufficient to pay off its debts, the private property of its member can be used for the purpose of paying off the debt. Okay, so in other words, the creditors can claim their dues from their members. Okay, if the creditors are if the creditors are not paid from the company, then the creditors can claim their dues from its member. Okay, so such companies are not found in India, even though it is permitted by the Companies Act. Okay, this kind of company is not found in India. Okay, company which is an unlimited company. Okay, next, on the basis of numbers of members. Okay, as I've told you, companies can be classified either on the basis of liability of its member. Under that you have three types of companies, that is companies limited by shares, companies limited by guarantee, and unlimited company. Okay, next, on the basis of number of members, it is classified. The company can be divided into two categories, that is public company and private company. Okay, now what is public company? A public company means a company which is not a private company. Okay, so it is a company which is not a subsidiary of a private company. Okay, so what is public company? A company which is not a private company is the public company, and it is a company which is not a subsidiary of a private company. Now, what is private company? A private company is one which by its article first restricts the right to transfer its shares. Okay, in private company, the members cannot transfer its share. Okay, second, limits the number of its member to 200, excluding its employees. Okay, so the members of private company can be only 200. Okay, that is the limit. Okay, so the limits of the number of its member is 200. Okay, excluding its employees. Next is, it prohibits any invitation to the public to subscribe for any share in our debentures of the company. So it does not invite the public to subscribe for the shares or debentures of such companies. Okay, and then it also prohibits any invitation or acceptance of deposit from person other than its member. Okay, director and relatives. Okay, that means private company, it prohibits any invitation or acceptance of deposits from members other than its from person other than its members, directors and relatives. Okay, so this is the private company. Next, we will move on to the share capital of a company. Okay, as you all know, as I've told you, a company is an artificial person. Okay, so it cannot generate its own capital, which has so it cannot generate its own capital. So it has to collect it from several person. Okay, since the company is an artificial person, it cannot generate its own capital, so it has to collect the necessary capital from several persons. So these person from whom the company collects the capital are known as shareholders. Okay, and the amount contributed by them is called as share capital. I hope this is clear. Okay, the person who give or who contribute capital to the company is known as shareholders, and the amount which is contributed by them is called as share capital. Okay, so since the number of shareholders is very large, a separate capital account cannot be opened for each one of them. Okay, so hence a numerous stream of capital contribution merges their identities in a common capital account called as share capital account. Okay, so now we will see categories of share capital. See, from accounting point of view, the share capital of the company are classified as authorized capital, issued capital, subscribed capital, called up capital, paid up capital, uncalled capital, and reserve capital. Okay, now we will see what is authorized capital. Okay, now authorized capital is the amount of share capital which a company is authorized to issue by its memorandum of association. Okay, so authorized capital is the amount of share capital which the company has the permission to authorize as per the memorandum of association. Okay, so the company cannot raise more than the amount of capital as specified in the memorandum of association. Okay, so it is also called as nominal or registered capital. So authorized capital is also called as nominal capital or registered capital. Okay, so this authorized capital can be increased or decreased as per the procedure laid down by Companies Act. Okay, so this is the amount of capital which is authorized or which a company is authorized to issue by its memorandum of association. Okay, so this authorized capital can be increased or it can be decreased as per the procedure laid down in the Companies Act. But it should be noted that the company need not issue the entire authorized capital for public subscription at a time. Okay, it cannot issue all the amount at a time. So depending upon its requirement, it may issue share capital, but in any case, it should not be more than the amount of authorized capital. Okay, so it cannot issue more than the amount of authorized capital. Okay, next is issued capital. Now, what is this issued capital? So, this issued capital is that part of authorized capital which is actually issued to the public for subscription. Okay, it includes the share allotted to the vendors and the it includes the share which is allotted to the vendors. Okay, so the authorized capital is that part of the issued capital is that part of authorized capital which is actually issued to the public for subscription. Okay, so this authorized this authorized capital cannot offer for public subscription is known as unissued capital. Okay, so the authorized capital which is not offered for public subscription is known as unissued capital. Okay, so unissued capital may be offered for public subscription at a later date. Okay, so I hope you all understood what is authorized capital and what is issued capital. So when I say authorized capital, it is that amount of shared capital which a company is given permission by memorandum of association. Okay, it is that amount of share capital which a company is authorized to issue by its memorandum of association. Okay, so the company cannot, in any case, it cannot issue more than the share capital which is authorized. Okay, next is issued capital. Issued capital is that part of authorized capital which is actually issued by the company for the purpose of subscribing to the public. Okay, and the part of authorized capital which is not issued is called as unissued capital. Okay, it may be issued for subscription to the company at a later date. Okay, next is subscribed capital. Now what is subscribed capital? See, subscribed capital is that part of issued capital which has been actually subscribed by the public. Okay, so it is the part of issued capital which is actually subscribed by the public. So when the share offered for the public subscription, okay, when the shares are offered for public subscription, and if they are fully it is fully subscribed by the public, the issued capital and subscribed capital would be the same. Okay, so what did I say? If the if all the issued capital is subscribed by the public, then there is no difference between the subscribed capital and issued capital. In this case, the subscribed capital and issued capital will be the same. Okay, okay. So what is the subscribed capital? It is that part of issued capital which is actually subscribed by the public. Okay, so if all the issued capital is subscribed by the public, then the share capital and issued capital will be same. Okay, but if all the shares are not subscribed by the public, okay, whatever is issued, then there will be difference between the issued capital and subscribed capital. Okay, in case if there is higher than what is offered, okay, if the public is subscribing for higher than what is issued, okay, then it is called as oversubscription. And if the public subscribes for less than what is issued, then it is called as undersubscription. Okay, next is called up capital. Now what is called up capital? See, it is that part of subscribed capital which has been called up on the shares. Okay, the company may decide to call the entire amount or part of the face value of the share. See, for example, if the face value of the share allotted is ₹10 and the company has called up only 7 per share, okay, in this case the called up amount is 7 rupees. Okay, and the remaining 3 rupees may be collected from its shareholders later whenever it is needed. Okay, so this 7 rupees is the called up capital here. Now paid up capital. Now what is paid up capital? See, it is that portion of called up capital which has been actually received from the shareholders. Okay, see, when the shareholders have paid all the called amount, the called up capital is same as the paid up capital. Okay, but if any of the shareholders has not paid amount on call, such an amount may be called as call in arrears. Okay, this is very important. Okay, so if any shareholder has not paid on calls, okay, if a shareholder is not paying the call amount, okay, then such an amount is called as call in arrears. Therefore, paid up capital is equal to called up capital minus call in arrears. Next is uncalled capital. See, uncalled capital is that portion of subscribed capital which has not yet been called up. See, in my example, I've told you, if the face value of the share is 10 and only if 7 rupees is called by the company to be paid by the public, then the 3 rupees which is not called to be paid is called as uncalled up capital. So this amount the company may collect from the public later whenever it requires that amount. Okay, so the company may collect this amount anytime whenever it needs this. Okay, next is reserve capital. A company may reserve a portion of its uncalled capital to be called only in the event of winding up of the company. Okay, so what did I say? A company may reserve a certain portion of called up capital. Whatever it has called up, it may retain. Okay, or it may reserve a portion of uncalled capital. So I repeat, students, again listen to me carefully. Reserve capital. So what is this reserve capital? A company may reserve a portion of its uncalled capital to be called only in the event of winding up of the company. Okay, so such uncalled amount is called as reserve capital of the company. Okay, it is available only for the creditors on winding up of the company. Okay, so it is that portion of the uncalled capital which will be called up only at the time of winding up of the company. Okay, so this is called as reserve capital. Okay, see in your textbook, page number 5, they have shown a note of account. Okay, they have shown you how much how is this share capital. Okay, first is share capital. Here they have given you an example. Authorized or registered or nominal capital. As I've told you, authorized capital, registered capital and nominal capital are one and the same. Okay, so it is 40 lakhs. Okay, so here 40 shares are issued at 10 rupees each. Okay, now out of this 40 lakhs share, issued share is 2000 share of rupees 10 each. So issued share is 20 lakhs. Okay, 2000 share of rupees 10. So 2 lakhs share of rupees 10. 2 lakhs into 10. So 20 lakhs. Okay, from this subscribed capital, okay, which is subscribed by the public, is 20 itself. Okay, out of which only 8 rupees is called up. Okay, only 8 is called up. Okay, so 2 lakhs into 8. So out of this only 8 rupees is called up. See, 2 lakhs shares are issued and 8 rupees is called up. So 2 lakhs into 8 is 16 lakhs. Okay, out of the 16 lakh, there is a call in arrear. Okay, 6,000 is a call in arrear which is not paid by the company. Okay, so when you deduct whatever is paid from your subscribed capital, whatever from your called up capital, when you deduct this call in arrears, whatever you get, you will have to put it on the outside column. Okay, so this is the subscribed capital. Okay, so first comes the authorized capital, that is the actual permission which is given by the memorandum of the company to authorize. Second is issued capital. So issued capital is that part of authorized capital which is actually issued to the public. Okay, next is subscribed. Okay, this is that part of issued capital which is actually subscribed by the public. Okay, next is called up. Okay, called up is that part of the subscribed capital which is actually called up to be paid by the public. Okay, so here called up is 8 rupees. Okay, 2 rupees is yet to be called. Okay, and here 6,000 is call in arrears which is not paid by the share by the public or shareholders. Okay, I hope this much is clear, students. If you have any doubt, do contact me. Jazakallah khairan.